In this video, we're going to discuss the birth of a stock, the IPO, or the initial public offering of a company's stock. The IPO is simply the first sale of the stock to the public. Once the company has completed the IPO, it no longer profits from trading of its own stock in the secondary market, which we will discuss separately. Prior to an IPO, a company is referred to as private. This is because the company is not open to public investments. According to the SEC in the US, there can be up to 500 investors and a limited number of transactions between those investors in a private company. Once a company decides that it wants to go public, that is, open itself up to public ownership, it can have any number of investors, depending on how many shares they issue and how many shares each investor purchases. So here is your private company, and it can have up to 500 investors. Typically it'll have fewer than 500 investors, but a public company, I don't know why I keep drawing houses for companies, but you get the idea anyway, right? Can have nearly infinite investors. Why would a company want to become public? Well, there's a few reasons. Primarily, it's looking to raise money. When a company lists itself on a public exchange, the proceeds from that initial sale, and remember the key word is the initial sale, go to the company itself. It can use this money to develop new projects, invest in new products, or it can simply distribute money to previous shareholders in return for selling their shares. In effect, this is providing liquidity to the initial shareholders and the founders. So if we imagine that this company has a few shares that it's selling off, maybe this particular block of shares belongs to the founder, and the founder wants to sell off these shares. Maybe it wants to sell off half of those shares. With the initial public offering, he can do so and can make potentially a load of money. By doing this, the company has also opened itself up to a much more diverse range of investors. And diversity, like most things in life, is important because in case some of your investors go belly up, chances are those same conditions won't apply to other investors and your money will be relatively safe. Another reason to go public has to do with credibility and reputation. There are numerous and significant regulatory and compliance hurdles that must be met before a company can go public. If a company is publicly traded, that means that it has the strength and the ability to meet fairly stringent requirements as set by regulatory agencies. As I mentioned before, in the US, that would be the SEC. Becoming a public company is also a major achievement in its own right. It means that a company has grown to a very significant size. Note that for most public exchanges, a company must be of a certain size in order to participate. There are a few downsides to becoming a publicly traded company. It's a very expensive and time-consuming process, and if IPO fails to generate enough interest, it can result in a net loss for the company. Public companies, by law, must reveal financial information in the form of financial statements. That is the balance sheet, the income statement, and statement of cash flows. By the way, we'll discuss each of these three in detail in another video, and you can generally tell the health of almost any publicly traded corporation using just the numbers that are available on these three statements. In any case, public companies must, by law, reveal that financial information in the form of public statements, and that information can be very advantageous to competitors. And for prior shareholders, lastly, the IPO can result in a dilution in the control of their company. For example, if we go back to this founder example, let's say the founder, in fact, controlled 51% of the initial shares. Prior to the IPO, the founder had 51% of all shares, but after the IPO and after dilution, the founder clearly has much less. In fact, there may not be any one investor with the majority of all shares. And for prior shareholders, the IPO can result in a dilution of the control in the company. If in the previous example we had the founder and the founder had 51% or a majority of the ownership of their company, afterwards that ownership percentage might be reduced significantly, as in the case here. I reduced it down to 20%, and no one investor might end up with a majority ownership. So once a company has decided that it wants to go public and execute an IPO, it will need to hire an investment bank as consultant. Let's draw a little. Here's a bank. Usually these are very large institutions. We'll give it a little flag. iBank for investment bank. It's the investment bank's job to determine the size of the IPO. And by size, what I mean is the number of shares and the price at which those shares will be issued. So if we imagine a private company that wants to go public, let's say it decides to divide itself up into 12 shares, right? That's one possibility. Or let's just copy and paste this. Maybe they decide that they want to create more shares and adjust the price accordingly. You can see that the company is the same size, i.e. the market capitalization of the company will be the same size, but the price and the number of shares will differ. So it's the investment bank's job to advise the company, as I mentioned, on the number and price of shares it will issue, and it'll underwrite those shares. If the investment bank has done its job properly, the share price will remain relatively stable in the aftermath of the IPO. If, after the IPO is completed, the share price increases significantly and dramatically, and more often than not means that the investment bank has misjudged the demand of the stock. For example, if the IPO is set at $20 a share, but within minutes the stock is trading at $100 a share, chances are the company could have offered the stock a lot closer to $100 a share and made significantly more money than it did at $20. Remember, once the stock is sold as a part of the IPO, the company no longer receives anything from the trading of the stock. Let's say our trader has bought this particular share and another trader has bought these two shares. Well, now once let's call this the IPO, and then let's call this the secondary market. Now there are other investors or traders, perhaps people who weren't able to access the IPO initially. They can now buy shares from the people who own them. Typically, the investment bank will be allocated shares that it can then offer to clients of its own brokerage. In many cases, these shares are used to reward wealthy clients or have done significant business with the IPO. So these guys would probably be very good customers of the investment bank, and the investment bank wants to reward those customers with shares of the IPO. It makes sense that these initial investors are pretty wealthy, and in practice that is usually what ends up happening. It makes sense because wealthy people are able to take on a little bit more risk than non-wealthy people. And for a newly issued IPO, there is very little track record. Actually, there's almost zero track record of the stock, so there's a lot more risk. Publicly traded stocks are listed on bourses or exchanges like the New York Stock Exchange.